Joining us now is Sarah Levy, CEO of digital investment advisor Betterment. She told us last month on the show, at the beginning of the month, that her digital investment advisor company was seeing inflows as the regional banks did see outflows. Sarah, it's great to have you back on the show. Do want to get an update from you. Since we have had more angst, more turmoil, we have even seen another regional bank that's basically closed down and had assets taken over.
So the momentum continues, which is really, exciting for our business. I think, as we talked about last month, what the regional banking crisis has done is, first of all, it's shined a spotlight on both liquidity and FDIC insurance in a way that I think the average retail customer wasn't perhaps as aware of previously. And so one of the ways we have sort of sought to reassure them in that context is to help them understand. And then we took the opportunity to raise our FDIC limits right after some of the banks started to go under, to really show our customers, we're here for you. This can be sort of a port in the storm, and there's safety in cash right now.
Yeah. So given the fact that we are potentially seeing some more stability in the banking sector right now, is that good or bad for you? And I ask that because I wonder, when people open up accounts, how sticky are they with Betterment?
It's a great question. I would say it's good for us. In general, high APYs, which we're currently offering 4.5% APY, makes for happy customers, right? And so at this moment of uncertainty, I think it's not just the regional banks. You've got the debt ceiling conversation, you've got inflation. There are a lot of macro factors that for the retail investor is causing uneasiness. And in that moment of uneasiness, we offer them diversification, including cash, which becomes part of a long-term investing solution. And so I think what we like is that our investors really believe in what Betterment brings, which is a perspective that investing and saving is long-term, and they generally stay the course.
Hi, Sarah. Good to see you. It's been a little while. I wonder how you're seeing retail investment behavior change and appetite for risk, as you've got people who are looking to indicate how much risk they want to take, how much they want to be maybe in high valuation stocks, given what we've been talking about so much attention going to the NVIDIAs and Apples of the world. They might feel safe, but valuation-wise, maybe they're not. How are you at Betterment as a robo-advisor factoring that in, and how has the retail investors' risk appetite developed over this year so far?
So I would say, if we start with the risk appetite part of the question, definitely we're seeing a risk-off posture. And again, back to the sort of high savings rate as the solution to that fear. Folks are seeing 4.5% and saying, let me take a risk-off posture. We don't offer single stock trading on our platform, so we're much more focused on a diversified long-term solution. And so what we're seeing is actually a different sort of time horizon behavior, which is to say we have a lot of retirement assets on our platform. Long-term retirement investing is really behaving as it always has, sort of slow and steady, consistent, stick to your plan. Where we're seeing a little bit of deviation is in the shorter time horizon investing. So if you think about taxable investing as maybe I'm saving for a home or an event, a wedding or an event that is nearer term, some of that money is shifting more to cash and less to the stock market.
But are Apple and NVIDIA and Tesla, are you factoring in the idea that they're more risky now because there's been such a valuation run-up in some of these, or does the risk-off investor, maybe who isn't investing in small caps because they don't like risk, are they piling into things that might end up in this environment being relatively more risky than they might think?
Well, our platform really seeks to continue to push people to diversification, right? So while we do see the S&P as part of our mix, we've got emerging markets in there. We've got a bond allocation depending on your time horizon. So when we look at the portfolios, we have very few investors on our platform actually customizing down to the sort of sector or even single stock level. So again, I think for us, it's more about, do you want to be in the market or do you want to be in cash?
Yeah, Sarah, you got Bitcoin Miami going on right now. You have a crypto platform as well. What are you seeing, given the fact that we have had a rally, albeit still very far from highs, in some of these cryptocurrency assets like a Bitcoin?
So we have a really interesting consumer who is pretty consistent. And so what we've seen is sort of slow and steady adoption. We launched the product and we launched diversified crypto portfolios. So again, similar to our thesis around TradFi, our feeling is play the asset class and incorporate that into a diversified portfolio. And over the long term, more diversification is better. And so that's the way we introduced crypto to our customers. We told them to keep allocations below 5% of their total investable assets. And that was our recommendation. And they've pretty much been following our advice, which is slow and steady, dollar cost average, and keep it below 5%.